In Signal episode 12, we uncovered how market momentum rotates, where each sector takes its turn in the spotlight. In Signal episode 13, let's deep dive into tracing how India's sectoral map has evolved through the years and what it means for your portfolio today. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. The Sensex closed at 83,939 points, down by 272 points from last week's close. The Nifty ended at 25,722 points, slipping by 73 points from last week's close. Markets were influenced by global bond yield pressure, profit booking in heavyweights, and caution ahead of the US Fed policy review. With October's earnings season wrapping up, the market paused to consolidate after a strong run. FMCG and pharma lent strength earlier in the week, while IT and banking faced pressure from margin concerns. Energy and metals saw selective profit taking, a signal of rotation rather than reversal. Foreign institutional investors were net sellers throughout October, while domestic institutional investors provided steady support, keeping volatility contained. The rupee ended near 88.8 per US dollar, underscored by firm US dollar and steady crude prices. The Sensex wrapped the month just below 84,000 points, while Nifty inched very close to 26,000 points, with both indices staying close to their all-time highs. This week, instead of separating story and strategy of the week, let's bring them together, because the story of how India's sectors have evolved is also the strategy that shapes our portfolios today. Each decade surfaces new growth opportunities, revealing how investors adapt as economy shifts its gears. The 1990s marked India's big opening, the liberalisation era. Banks and IT companies became the new face of opportunity. I still remember back in school we debated whether liberalisation should be allowed. I was firmly for it. Looking back, I'm glad I was. That single policy shift changed the destiny of India's economy. It was the decade that taught India how to dream globally. The 2000s brought infrastructure boom. Power plants, roads, and real estate dominated headlines. Around mid-2000s, bank credit and corporate lending surged, fueling the India growth story. Metals and capital goods became the engines of expansion. Optimism was everywhere. The 2010s shifted the focus from scale to stability. After the global financial crisis, investors sought consistency. Consumption, private banks, FMCG, and pharma defined the decade of quality. Resilience became the new growth. And now in 2020s, digital, renewables, and manufacturing have taken the center stage. The China Plus One strategy, the green transition, and India's digital backbone are reshaping markets' momentum. This is by far India's most diversified growth decade. This pattern of shifting strength is not new. Market historians and economists have mapped this for decades. One of the most insightful among them is Sam Stovall, author of Sector Investing. He explains that sectors move in rhythm with economy, expanding, consolidating, and rotating as cycles evolve. The Sector Compass provides a modern framework to understand how sector rotation evolves over time, not as randomness but as market's natural heartbeat. So, where do we stand today? In 2025, we are again in transition. Cyclicals like infrastructure, banks, and realty are leading. Defensives like IT and FMCG are resetting. Gold has been a clear stunner performer. The message is very clear. Markets are broadening again, and selectivity matters more than ever. And that's exactly where the idea of sector compass comes in. When opportunities widen, you need direction. You need a framework to decide where growth lies, where stability sits, and how to stay balanced through rotation. So what exactly is a sector compass? Sector compass is a simple way to understand how your equity allocation can be further divided into three segments: growth, defensive, and diversifiers. It helps you see how each segment behaves as the market changes over time. Does this cover your entire portfolio? No, and that is important. Sector compass only covers growth component of your portfolio or your equity exposure. And how does sector compass work? It groups equity sectors based on how they behave during different phases of market cycles. Let's deep dive into Sector Compass Matrix, a visual guide that shows how equity exposure can be balanced across growth, defensive, and diversifier segments. This is the Sector Compass Matrix, a snapshot of how different portfolios distribute their equity exposure across growth, defensive, and diversifiers. In the second column, you see the growth engines, sectors like infrastructure, banks, auto, and manufacturing. These are the economy's accelerators. They thrive when growth expands and credit flows freely. In the middle column, the defensive anchors, IT, FMCG, and pharma. They are the steady hands of your portfolio, reliable when volatility rises, consistent when sentiment weakens. And in the third column, the diversifiers and hedges. Gold and global funds, and for more sophisticated portfolios, even REITs, InvITs, commodities, or other alternative assets. Together, they serve as stabilizers, protecting your portfolio during global shocks or domestic slowdowns. As you move from aggressive to conservative portfolios, the balance shifts, just like changing gears in a car. Aggressive portfolios carry more growth engines, moderate portfolios strike a measured balance, and conservative portfolios lean more on defensives for stability. Across all, about 15% stays with diversifiers and hedges, your constant safety belt through every market cycle. The goal isn't to predict who leads next, it's to stay prepared for whoever does. And if you're wondering how to build your own sector compass, a SEBI-Registered Investment Adviser can tailor a personalized sector compass by aligning it with your goals, risk appetite, and investment horizon. We are building a strong community of savvy, strategic, and seasoned long-term investors. If you're one of them, why not like and subscribe us and tell us in comments which sector are you most bullish on for 2026.